Welcome to this Scientific Beta webinar on managing sector risk in factor investing. I am Eric Shabini, Global Head of Research and Investment Director at Scientific Beta. And today I'd like to welcome Daniel Oge, our Deputy Head of Research. Hello, Daniel, and welcome.
Hello, Eric. Thank you.
Scientific Beta has been quite vocal recently, I have been quite vocal recently, about highlighting the hidden risks or implicit risks of smart beta strategies that greatly affect the short-term performance of these kind of strategies. Now, one very important implicit or hidden risk is sector risk. Daniel, you've recently published a white paper on the importance of looking at sector risk, and you're here to share some of your findings with us. So let me begin by asking you, what do you mean by sector risk?
Okay, well, the main objective of smart factor investing is to deviate from the cap weight index because the cap weight index is not efficient. So by deviating from the cap weight index, we implicitly take some sector risk. We can see in the slide number 2 the sector relative allocation of our flagship index compared to the cap weight index. And we see that the relative allocations are time varying and can be quite important. So the main issue with being exposed to sector is that you expose yourself to some specific risks that are unique to the sectors, like let's say the tsunami that hit Japan in a few years back. And the smart factor index can undergo negative performance on the short term. So even if sector risk is not priced and not rewarded on the long term, we have no empirical evidence or academic evidence on that, they can have negative impact on the short term.
And how would you suggest we control for these sector risks?
So we have a two-way process to control sector risk. The first is based on stock selection. Instead of doing the stock selection in the whole universe, we select stocks in each sector. We do that to maintain the sector diversity of the stock selection, to avoid to be concentrated in a few sectors. If you take the example of the low volatility factor, at some extreme points, we might be invested in only a few sectors and have no exposure to some sectors. So it is impossible if we have no stocks in a specific sector, we cannot be sector neutral. So we need a sector diversity to achieve sector neutrality. The second step is a weight rescaling process in which we try just to match the sector weights of the smart factor to the weights of the cap weight index. So in the end, we have sector neutral indices, but they are not perfectly sector neutral because we want to maintain a high level of replicability of our indices, and we apply liquidity and turnover rules that alter the sector neutrality. So we will see in the next slide that we have some residual exposure to sectors, even though we have the sector neutrality.
Thank you, Daniel. So what you're doing is you're performing your stock selection within each sector, within each industry, to ensure that you have representation, and then you can apply your sector neutrality, even though it may not be exactly sector neutral at the end. So what are the benefits? Let's look at the benefits first. What are the benefits of applying sector neutrality?
Yes, the main benefits are risk management of short-term risk. We show in this slide two types of indices, the standard smart factor indices and the sector neutral factor indices. And we show relative performance. So if we look at the tracking error between the two types of indices, we can show that in average we have a 20% reduction of tracking error, which is huge, and they are statistically significant. Another important aspect of risk management is the reduction of extreme relative risks, like the maximum relative drawdown, which is on average reduced by 30%, and the 10-year rolling worst tracking error, which is reduced by 20%. So by reducing the tracking error, we are able to improve information ratios. They are not statistically improved, but still we observe an improvement.
So clearly there is a benefit from a relative risk perspective. You're able to reduce relative risk, relative extreme risk. That's what our long-term performance shows, long-term analysis. But what about the shorter term? What has the impact been, particularly recently? I think it's probably been an important factor.
So in the next slide, we show the performance of our flagship index, the Psi Beta developed HFI diversified MBMS index. We show the standard index and the sector neutral version of the index over the last 10 years. We show that sector neutrality improved the stability of relative returns. This is seen by several elements. The first one is that we have lower tracking error that show that relative returns have less variation. They have lower magnitude. If we take the spread between the max and the mean relative returns during the years, we reduce the spread. So the standard index has 9.5% of spread. The sector neutral index has only 8.3% of spread. And we improve the information ratio. Now, as you said, the last few years have been marked by some outperformance of the technology sector. And I want to focus on the last 2 years. So in this slide, we show the performance of the Psi Beta, our flagship index. And on the first graph on the left, we show the exposure of the technology sector of the standard index and the sector neutral index. We can show that in average, during 2017, the standard index had a negative exposure to the technology sector of about 6%. The sector neutral version had an exposure of -3%. It's almost the same numbers for 2018. We also show on the left graph the outperformance of the technology sector, which was amazing. I mean, 14% in 2017, more in 2018.
And that's relative, isn't it?
It's relative outperformance, yes. So the direct impact on our smart factors is clear. We can show that in the right graph, sorry. We show that in 2017, the sector neutral version outperformed the standard index. And in 2018, the performance are until the end of August, we show that the sector neutral version is slightly positive, whereas the performance of the standard index is clearly negative. So it's a very clear example of what can be sector risk and the negative impact it can have on short-term performance.
Yeah, I can quite clearly see the benefit of applying sector neutrality. It stabilizes the relative returns, and particularly over the last couple of years, this has been very important. So why not just apply sector neutrality as your default option?
Yes, so there is no free lunch in finance. So despite the clear benefits on the short-term risk management, sector neutrality comes with cost. The first cost is due to the reduction of the distance to the cap weight index implied by the sector neutrality. So we are losing some. We are applying sector neutrality makes your index more close to the cap weight index. So you will have the more close characteristics of the cap weight index. And we can see that the reduction of distance between standard and the sector neutral index is quite huge. We have a reduction of about 60% in average. And this reduction of distance has two important consequences. First one, there is a reduction of risk-adjusted performance through an increase of volatility and a decrease of returns. So This is important for investors because when you want to invest in smart factors, you want to have the highest possible risk-adjusted performance. Okay? The second important impact is the factor exposure to the desired tilts that are dramatically reduced. We see that for the single factors, the mid-cap, value, high momentum, the exposure to the desired tilt might be reduced by more than 50%. So it's really important and can have a negative impact on the overall factor intensity of smart factors. So, in summary, investors are less efficiently exposed to long-term rewarded risk factors with sector neutrality, and so they should expect lower risk-adjusted performance.
Okay, so sector neutrality has a price in terms of long-term performance. Thank you very much, Daniel, for providing a very clear understanding of sector risk and the implications of adjusting for sector risk. So let me just conclude by the main points that I have drawn from this presentation. Sector neutrality is efficient at controlling short-term risk. Sector neutrality helps you to reduce the relative drawdown, helps you to reduce tracking error and extreme tracking error, leading to improved information ratios. But this improvement comes with a cost. Applying sector neutrality leads to a reduction in terms of factor intensity, and this reduction leads to a reduction in terms of long-term risk-adjusted return and a slight increase in terms of volatility. So at the end, in terms of whether investors should apply sector neutrality to their strategy or not, depends on the investor's preferences, on the investor's aversion. If they are concerned about relative risk, then they need to apply sector neutrality, but that has a cost in terms of long-term performance. If they are not concerned about tracking error, there is no need to apply sector neutrality, because a strategy without sector neutrality, you're able to achieve the highest absolute risk-adjusted return. Is that right?
Yes.
Thank you very much indeed, Daniel, and hope to see you again soon. Thank you.